Happy Thanksgiving to everybody here, and thank you for joining us. And I love Bitcoin. I love cryptocurrencies. I am actually one of the founders of a cryptocurrency myself. But today we're going to be talking about the smart money setups. The whole market right now, guys, is in a very precarious scenario. We have had the talking heads predicting a market crash since February of last year. And of course that hasn't happened, but we are certainly building towards a very dangerous top. With that in mind, we'll quickly talk about the disclaimer. We're going to be talking about live markets today, so please consult a financial advisor before taking any action, as Acorn Wealth is not a financial advisor in any jurisdiction or province. All right, so we'll move on. Today's agenda, I want to take you basically straight down to the roots of where this market is at, because we may be very close to a turning point. And we're going to go through some of the key smart money setups that are indicating that and what that could possibly mean for the market. We're also going to talk about why that means it's very important to have an edge. This is not the kind of market where you can just simply follow the normal kind of breakout head and shoulder patterns or ascending wedges or things like that. You need a little bit more in these market conditions. And so we're going to be talking about that. And the whole premise of everything that Acorn does is to follow a systematic approach of how we approach the market and come to these conclusions in a step-by-step way, and then how we apply that through a repeatable process or a quantifiable process, because at the end of the day, trading is all about consistency. So the way we make all these decisions and how we trade from those decisions has to have a consistent strategy. So let's talk about the market. Right now, as we probably are all aware, the S&P 500 is now at record high levels. If you look at this graph, this is developed by Hussman Strategic Advisors, and this is a P/E Shiller ratio, basically looking at how much companies are priced at versus how much they make. And it displays what the ratio of that is over the last, well, almost 100 years, all the way back to 1928. As you can see, the market is now at levels that we've never been in before. The leverage that exists at the moment is unprecedented. In fact, we have got more money in the market that is borrowed, basically, people gambling on margin, than we've ever had before. So that's one factor. And if we go on to have a look at how that reflects in terms of the charts that you and I can see every day, it tells the same story. So a lot of the time you'll tune into BNN, you'll tune into CNBC, and people will say, hey, what's the market doing? What's the stock market doing? And people say, oh, markets are up. Markets are up 2% today. Fantastic. Everyone go and borrow some more money and buy some more stocks. But one of the first things that you have to realize when you're trading the stock market is that it is not a stock market. It is a market of individual stocks. And so while we look at the stock market or the S&P 500 and say, well, look, great, we are going higher. If you actually have a look at what the stocks in the market are doing, it's a very different story. So let's start with looking at some of these smart money indicators, because that's what we're all here to hear about. What is the smart money doing? Well, one of the first things that I like to look at in terms of smart money is high yield bonds. And let me just, we'll just get off this to a new screen here. Okay, so what are high yield bonds? Well, high yield bonds are a great indicator of what the smart money thinks about the US economy. Because what high yield bonds are, these are the places that, well, essentially these are loans to corporations. They're corporate debt. So if corporate America is in good shape, and smart money believes this, they will say, okay, no problem. I'm quite happy to buy corporate debt. I believe that my money is safe lending money to corporate America. I will get a return. And therefore they buy high yield bonds. That's essentially lending money to corporate America. So if corporate America, if smart money believes in corporate America, high yield bonds go up. If they do not believe in the health of corporate America and they don't think it's the safest place for their money anymore, high yield bonds go down. So it's a great smart money indicator because it basically gives you a snapshot instantly of where the biggest money is going, because bond traders are big money. They're smart money. So when you look at HYG, what you'll see is a very interesting chart because the stock market has been going up. But what do you notice about high yield bonds? They've actually been going straight down. In fact, high yield bonds topped out on October 20th and have been plummeting ever since. And if you want to start applying some technical analysis to this chart, it actually shows an even more interesting scenario. So what you'll see here on high yield bonds is that we've actually formed an almost perfect head and shoulders pattern as of today. Left shoulder, head, right shoulder. And a lot of people, when we draw head and shoulders, say, well, it's easy to see in retrospect. On October 2nd, here, this is where we actually drew these lines out. On October 2nd, we anticipated a drop to 86.20, a rally from there, and then we talked about this possible right shoulder forming, and that if it did, this would be a very interesting and high probability short setup. So as we sit in terms of high yield bonds, we are seeing a major divergence and the number one top ranking bearish pattern in a bullish market, which is the head and shoulder pattern. So in terms of looking at smart money, so far we are at this peak. So what else can we look at? Well, as I said, it is not a stock market. It is a market of individual companies. So let's now turn our sights to what those individual companies are doing. And to do that, what we're going to look at is the stocks in the market, which within this program is $MMFI, Mike Frank Indigo. You can also search for stocks above their 50-day average in Google, and Bar Charts has an online version that you can view. And essentially what this indicator is or what this chart is it's a percentage displaying how many stocks in the stock market are above or below their 50-day moving average. Well, so why does that matter in the first place? Well, the 50-day moving average is a fairly important moving average. It represents where institutional buyers often buy at, mutual funds, larger money, longer-term investors. And if stocks are failing to bounce off of their 50-day moving average and therefore they're breaking below it, it means that smart money doesn't see these stocks as a buying opportunity, but rather they're letting them go and most likely selling them. So if you have a look at a weekly chart of stocks above or below their 50-day moving average, in fact, we go to a monthly chart. Let's have a look which displays best. Probably the weekly. If we look at the weekly chart all the way back to 2010, what you'll notice is that this indicator has oscillated back and forth within a very predictable range. In fact, if you look at the last, 8 years, you'll see that 1, 2, 3, 4, 5, 6, 7, 8, 9 times it has hit this 80% mark. Stocks have precipitously dropped from that exact level within 1 week of hitting it. So as soon as we hit the 80% mark, stocks have plummeted from there. Whenever we've gone past it, and that's only been 1, 2, 3, 4, 5, 6 times, we've only lasted up there for 3 or 4 weeks. So this is a great indicator, because if you look at any crash or correction that we've had in this entire period, any 10%, 5%, 20% or more pullback, in every single case, this has been a leading indicator of that happening. Weeks, sometimes even months beforehand. Because once again, it is not a stock market. It is a market of individual companies. And if you're always watching the S&P 500 saying, well, the S&P hasn't crashed yet, it's still going higher. If you're using that as an indicator as to when you start searching for the best shorts, you're going to miss them. Because the best shorts, the weakest companies, the ones that will make you the most amount of money, most likely, are going to be the ones that drop far before the market does. So if we put this in perspective of where we're currently at, we are in a situation where the amount of stocks above their critical support points has dropped from 80% all the way down to 42% just a couple of weeks ago. If we look at high yield bonds, also a leading indicator in every market correction in the last decade, we can also see that high yield bonds are selling off in one of the most highly probable patterns that exists in the stock market if you're any kind of technician. So we have 2 leading indicators both giving us warning signs. And on top of that, if we reflect on the S&P 500 itself, we are in a situation where the S&P 500 is also building a bearish pattern. Let me just take all these unnecessary things off the chart. The S&P 500 itself is building in a possible head and shoulders as well. So that is the kind of market we are in, folks. And I don't say that to scare you, because when I say this, it actually, I think, is a very exciting thing. This is where opportunity comes from. But the main takeaways is that markets are at dangerous highs. This has been something that's been going on for quite a while. And if we ignore these situations, you could very easily see any kind of gains you've been making in this very interesting bullish market wiped away. And you could also miss a fantastic shorting opportunity. So now more than ever, it is very important to have an edge, because right now, as much as I might be singing the bearish song, I think probably 80% of my capital is in long positions. So I'm by no means telling you sell everything and short the stock market. What I am saying is that, you know, if you want to follow, you know, the kind of biblical examples, Noah didn't build his ark the day of the flood. You know, if we're looking at the stock market and we're seeing that these red flags are giving us very big red flags, what that means is let's be very careful about where we put our capital. And to me, that means that we can't just take any kind of traditional buy or sell signal at its face value. We have to have something extra, that extra bit of edge. And to me, that is following the smart money, right? Following the smart money. So most people in the stock market lose money because they are following emotionally based decision making, right? Most people lose because they are following emotional decision making. One of the first things I was taught growing up was follow the money, follow the trail of money. And I think that's one of the best indications you can see in the stock market as to where investments are well placed. One of the other things I was taught when I was growing up was it's not about what you know, but who you know. You know, look at who is behind the stock, who is behind the idea. See, most people don't have those kinds of connections. Most people don't get to sit around the table with the CEO of Apple and share a scotch with him and find out what's going on with Apple this week. But what we all have the ability to do is to follow where the smart money is investing, because they're essentially doing all of the research for us. The people that are going to be able to outperform any kind of research you and I would hope to do are the people that run these companies, the people that do sit down with the CEO of Apple and have that scotch. And where they put their money is going to give us an indication far better than any kind of research we could do as to where they anticipate the company is going next. And that's what I think is the most important thing, is the most important thing. Because if I see that a CEO of XYZ company who's got $50 million in his own company all of a sudden decides to double down and throw another 50 million in, I don't care what research I've done, am I really going to say, nope, I disagree. I think the CEO of that company is dead wrong. I know better. I'm going to short it. Of course not. And if I see a company that I'm thinking is a good long, a good buy, and I see that the CEO and the senior vice president and the general counsel and the chief financial officer are all selling 60% of their holdings in their own company all at the same time, right before earnings, do you think I'm going to go and say, no, they're wrong. They're totally wrong because I've done all this research? Of course not. So if you wouldn't go against them, it makes obvious sense to start following when this type of action is happening. And if you can combine that with the technical timing of when it's right to take that trade, that is the winning argument, in my opinion. I've been doing this for, Acorn turned 10 about 2 weeks ago. And I've used every indicator you can possibly imagine. If you want to talk about analysis paralysis, you're talking to the right guy. I used to look at 15 different indicators at one point. I used to look at, what Jim Cramer was saying. Then I would read stock twits. Then I'd look at the bull boards, and it would take 2 hours to argue with myself as to whether it was a great short or a great long. That's futile. You have to simplify it. You have to bring it back to what really matters, which is where is the money going? And that is quite an easy process. It's simplified by bringing it back to two things. What is the pattern of the stock? And that gives you probability and timing. And secondly, where is the smart money going? What are the insiders doing? Do the insiders confirm this pattern? Patterns, being the first part of it, are critical because this is where the volume comes from. If you want to know who controls the market, well, volume controls the market. So who dictates the volume? Well, smart money does. They estimate that 70 to 80% minimally of the volume in the market comes from high frequency trading and other similar situations. So the way that they make these decisions, the way that these bots are programmed, is based on algorithms that are preset where they buy and sell at. And I'm sure most of you already know this. So understanding what the pattern is on the chart allows us to know when we can be going with those high-frequency trading algorithms versus against them. That gives us the timing. And the second part, of course, is then once we have an idea that there is a great long or short, we can then start to look at what the smart money is doing and if they are in favor of it as well. And if we get all of that marrying up together, then we have a winning scenario. And this is where we get our edge. That is, I think, very important, specifically in this market. So let me show you a few examples. MRTX is one of the first. MRTX was a long that we suggested to our students back on August 21st. Now, if you have a look at MRTX, you'll see this exact example. You've got a 10% owner that was increasing their position by 3.2 million and continuing on from there. You've got another, the president and CEO who also increased their position by 70%. So this is people saying, right, I've already got a bunch of money in this thing, but that's not enough. I need to put even more money in. And there's only really one reason that happens. It's because of what? Greed. It's the urgency that there is a big upside potential that is worth the risk. And especially when you see percentages like 70%, 80%, I mean, really anything above 50 is where someone's really getting involved. So if you want to see what happened next after these guys loaded up, we'll bring it up on the chart. So as you can see, after they loaded up with these millions and millions of dollars, the stock climbed from $5 all the way up to $18.50. So this is again, when you start to think that, geez, the market's unfair, it's the people that are on the inside that make all the money. Well, you're absolutely right. So why not watch them? Because rather than relying on tips from your friends and things like that, just watch the people that own the damn things. What they are doing is there for you in blind sight, so to speak. And these are the kinds of moves that happen. This was one. This is one we alerted to our students. These are not hypothetical things where we're looking back in the past. These are actual things we sent out to our students. TRXC was another great example. Maybe some of you have heard about this. This was a biopharmaceutical company that got approved by the FDA. Second company in history that was approved by the FDA for a surgical arm to do surgery. The last company went from $8 to $360. That was ISRG. This is the second company to do it, and they were just approved a little while ago. But have a look at the insiders. The director increasing his position by 208%. The other director increasing their position by 150%. Just look through the numbers. Have a look at the chart. It looks eerily familiar. Same kind of thing. Nice big drop down. Forms this lovely little base, kind of like a ski jump is what we're looking for. And as you can see, broke out of this resistance here, and it just went for a tear. 82 cents was where we found it at. I ended up selling at $4.38, I think was my average price, and I've actually bought back into it since for a longer term hold. For full disclosure, I still own a position in this. And that's exactly what we send out. That was an overnight almost $10,000 profit. And as you can see, this is a little excerpt from my brokerage, selling at 440, 418, and 438. It's not rocket science. We're just simply looking at where is the money going. I mean, we have a lot of examples of this. and we can talk about it all day. But when you start to bring things back to simplicity, I mean, again, this was another really good example, FRTA. Again, FRTA, as you can see, again, this is an excerpt from my personal brokerage statement. Bought this at $5.40 and sold it at $7.89. Why? Well, let's have a look. FRTA was once again, if you have a look, that very similar pattern. This beautiful downward trend, a huge drop, which is what I call a fallen angel, a stock that is being absolutely punished, that has strong underlying fundamentals. So, you know, a good reason why it's going to be hanging around. And while everyone else is selling the hell out of it, the insiders are loading up. So once again, two things matter. The pattern, which is where 80% of the volume comes from, and the smart money, which is where the conviction of the thing continuing to move comes from. And once again, in this scenario, we bought this just as it started to break out from this $5 level. Again, that nice little ski jump, rallied up. And if you have a look at the insiders on this one, you'll see what I mean. I'll just load that site up here for a second. Here we go. Should be coming up on your screen, FRTA. There you go. Have a look. Over 999% increase, 132% increase, 92% increase, 50% increase, brand new buyer, 279% increase. All of these purchases coming in around $4. And surprise, surprise, the stock almost doubles. Okay, and again, these are trades, I was in this. This is the kind of stuff that we look for. In at 540, out at 789, and all pre-programmed. TTI, one more example here. Once again, all of this is the same stuff we're looking for. I mean, trading this way is boring because you're not trying to reinvent the wheel. You're keeping it simple. What is the pattern doing? Where is the smart money going? And this accounts for where stuff goes. I mean, you can layer as much unnecessary stuff on top of this as you want, but really what matters is where's the money going. And I mean, I think as traders we tend to want to overcomplicate things because we feel like the harder we work, the more money we'll make. It's in trading I find it's the opposite. The best performance I ever had up until recently was when I kept it simple, when I didn't even know how to short back in those days. I was long only with one pattern and I was kicking butt. And then I said, wow, this is great. I'm gonna learn about 10 more indicators. I'm gonna learn about this. I'm gonna learn about that. I'm gonna be a commodities trader. Now I'm gonna get into forex. And the more and more I knew, the less money I made. I mean, really, let's just keep it simple. This was a simple setup. Once again, same thing. Big drop. Look at the little ski jump down the bottom. Little ski jump. Consolidated and broke out. And look at the insiders. As you can see, insiders all buying right there around $3.94, which was higher than where we found it at. We bought it at, well, I bought it at $2.81 and sold it, half of it at $3.43 and the second half at $3.98. Again, and all of that pre-programmed. So this doesn't just work for longs, because as I mentioned earlier, this is not a stock market. It is a market of individual stocks. And the moment you get locked into reacting to the market based on whether the S&P 500 is up or down is the moment you can easily lose sight of what the goal is, which is to find the individually very strong or weak stocks or opportunities. This was a great example of one in the opposite direction, one that you would have missed if you were thinking the market's continuing to go higher, therefore I'm not going to look for shorts. This company, Blackhawk Networks, was a similar situation in the opposite direction. Let's start with the technicals first. This was again, Head and Shoulders is the #1 performing pattern to predict a top. All right, so when you start to see a Head and Shoulders that's forming very well, like we are in high yield bonds and the Dow Jones Transport, but that's another issue. When you start to see a Head and Shoulders building, you take notice. And here you can see a beautiful Head and Shoulders that had formed in Blackhawk Networks. Left shoulder, right shoulder, perfect. That was the first signal. That's the first smart money signal, is where is all that volume going? Where is the high frequency trading boys? What are they doing? What is the playbook? Second, you had a second Head and Shoulder inside the Head and Shoulder. And if you look carefully, there it was. Excuse me. You had one inside the other. So you had two of the highest probability setups within one another. Thirdly, you had a pennant. So all three of these signals all saying, hey, this thing's going to wet the bed. and look what it did. It went straight down to exactly where those targets were. So what you can see is essentially all of these technical systems all lining up within different time frames, all suggesting the same thing. In other words, a perfect storm. And look at the smart money. So as these perfect storms built up ahead of their earnings announcement, have a look at what the insiders were doing. We're seeing significant selling from the senior vice president, the chief accounting officer, chief financial officer, everything. CEO, president, all selling in the sum of millions of dollars. And surprise, surprise, the thing plummets. So, I mean, again, you can do all of this research yourself and come up to the solution of whether you think the company is good or not. But the point is that the smart money is giving us those answers. There are people that are paid millions of dollars a year to do this research for us. They are the insiders of their companies, and they are everyone else in their peripheral that trades the big bucks. And where the company is going is printed in the money every single day. So it's not foolproof. It doesn't always work, but it works a hell of a lot of the time. And when it does work, I mean, you're dealing with sometimes very explosive moves. You're not dealing with these this wish-washy market we're making a 5% profit using the typical technical patterns is difficult right now. I mean, if you're just relying on what worked 5 years ago, it's much harder. But in fact, if you simplify it back to watching where the smart money is going, that's where all these big moves are coming from. And that's why we've filtered our strategies back down to specifically this, looking only for where the stocks are. I mean, the most recent trade, this isn't even in our slide deck, but this is one that I just got out of. I sold some today, and I sold the bulk of it a couple of days ago at, what was it, 160 something? Anyway, same thing. Look at the stock, AMPE, same downward trend, same little ski jump, and then if you have a look, rallied up, formed a pennant. I got in at 123, and it just shot straight up from there. But, so the pattern was perfect, and again, look at the smart money. all loading up. 66% increase, another 66% increase, another 20%. And if you actually have a look at this guy's history, which is what we do in our scanning process, we found that he had a perfect track record of buying stocks that he was involved in at the absolute bottom, and things just going well, essentially. So this is what the smart money is all about, ladies and gentlemen. And this is what we do. This is what we do every day, and this is the background to all the trades that I do. Yes, I think we have, I guess, 5 minutes left if we're running 5 minutes over. But I mean, I like to share some of my, my personal results here because, this isn't hypothetical. This isn't just a good idea we think you might like. This is stuff that I have a significant amount of money invested in, and a scan that I run every single day looking for these opportunities. Because once you start to define exactly what you're looking for, you can scan for it. And that's what we really cornered the market on, is developing a scan that finds the insiders with the best track records that are taking significant percentage increases in their positions, along with many others alongside them, as well, and importantly, as having the perfect technical timing. And this allows us to really refine quantity of work down to quality of work. And I see so many traders spending hours and hours a day, and they're not making any money. In fact, a lot of the time they're losing money. That just sounds like a bad paying job. If you know what you're looking for, then you shouldn't have to spend all day looking for it. You should be able to allow a computer to do that for you. And that's what we've spent the last 10 years developing, is scans that find this for us, and then what we then provide out to our client base, our students. And that's really what I'm here to offer you today. I'm not here to sell you a $5,000 piece of software or some magic tool. What I'm going to give you is a way to just tag along with our research in the spirit of Thanksgiving Friday. Is that what it's called, or is it just Black Friday? I'm an Australian in Canada that used to live in the US, so I'm a bit of a mishmash of it all. Look, we send these alerts out all week. Every single time I take a trade, I send it out via text message. And in most cases, if I was aware of it the day before, we send it out the night before saying, look, I'm going to be buying this stock at this price with this stop loss and this target the night before. I'd say 98% of everything we do is all pre-programmed the night before. So for $9, you get a little bit of insight and can tag along with us for the next month, which is going to be one of, I think, the most exciting months we've seen in a long time. If these high yield bonds start to break down from here, going into the beginning of December, this could be one of the most, it could be one of the most awesome shorting opportunities, at least in the short term, if not possibly much further beyond that we've seen in a decade. So what that's going to mean is you're going to want to know which of the companies that have the highest levels of insider selling, which of the companies where everybody is getting out in droves, not by 10%, but which of the companies where the insiders are selling 50, 60, 70% of their company. And not just one, but 5 or 6 of them. And this does exist. That's the beauty of it. This happens all the time. You just need to be knowing where to look. You'll get a month of those alerts. We're going to be sending out a special report this weekend, which is our smart money setup. The corrected link doesn't have the / at the end. It's just acornwealthcorp.com/win. There's no / at the end. I've just put the correct link into the chat box. So you'll get those alerts for the next month. You get a video every night telling you what I'm buying with my money and how I'm playing it. You'll get our smart money indicators. You'll get text alerts. You'll get instructional on-demand videos as to how to use those smart money indicators. And as I said, this weekend we'll also be doing a very special video report detailing our favorite setups based on the highest level of insider buying or selling. This is exactly where AMPE came from. And to coincide with that, you'll also be getting live classes every Tuesday, Thursday night at 4 p.m. Pacific that you can join into to ask questions and see the ongoing analysis to follow through with that. So it's a great trade if you think of it. $9 is your risk. And if we have any kind of performance like we've seen over the last month, there's a very significant upside. So I think maybe we are pretty much out of time here, I believe. So the $9 is a one-time charge. Following through with that, you can continue at $59 or $140 a month, depending if you want one-on-one coaching included or not. And you get all of those options at the end of the 1 month. So go see how much money you make first over that period and then make that decision towards the end. But there's no commitment, no contract, completely up to you based on your results. So I'll turn it back over to Hubert and the team over at TradeThirsty, and thank you for organising a wonderful event. I'll put our email address in there if you have any more questions.
Thank you, Johnny. Thank you very much. All right, so acornwealthcorp.com/win. acornwealthcorp.com/win. It is in the chat box. It's also in the Q&A.